Ever wondered how to backtest your Forex trading strategy? Well, you're in the right place. Welcome to our comprehensive guide where we'll unravel the ins and outs of backtesting in the Forex trading world. Backtesting, as you'll soon discover, is a powerful tool that allows traders to evaluate and refine their trading strategies. It provides a hindsight perspective, enabling you to assess the potential effectiveness of a strategy before you put your hard-earned money on the line. This approach can be a game changer, providing valuable insights and helping to mitigate risks. In today's fast-paced and unpredictable trading environment, understanding how to backtest your strategies could be the difference between success and failure. It's an essential skill that every Forex trader should master. So buckle up as we dive into the world of backtesting in Forex trading. First things first, what exactly is backtesting? Well, imagine you've just cooked up a new recipe. Before you serve it to your dinner guests, you'd likely want to taste it first, right? Essentially, that's what backtesting is in the world of Forex trading. It's a way to test your strategy using historical market data before you risk your hard-earned cash. Backtesting is a simulation, a way to play out your strategy in the past to see how it would have fared. It's like watching a movie of your trading strategy in action, except the movie is set in the past and the actors are historical market data. This process serves a dual purpose. Firstly, it helps you to understand the potential profitability of your strategy. It's one thing to have a hypothesis about market behavior, but it's another thing entirely to see how that hypothesis would have played out in real-world conditions. Secondly, backtesting allows you to gauge the risk associated with your strategy. It's a reality check, a way to see how much you could stand to lose if market conditions turn against you. No strategy is bulletproof, and backtesting helps you to quantify and manage your risk. In the volatile world of Forex trading, backtesting is not just a fancy extra. It's a vital part of building a robust trading strategy. It's akin to the rehearsal before the big performance, the practice run before the race. It can help you to refine and adjust your strategy, smoothing out any wrinkles before you go live. However, it's important to remember that while backtesting uses real data, it's still a simulation. It can't predict the future or account for every possible market condition. But what it can do is give you a solid foundation of confidence in your strategy, backed by historical evidence. So, to sum up, backtesting is a bit like a time machine for your trading strategy. It lets you travel back in time to see how your strategy would have performed under historical market conditions. Backtesting is a crucial part of developing a solid Forex trading strategy. Now, let's move on to the process. So, how do you go about backtesting your Forex trading strategy? Well, the process of backtesting isn't as daunting as it might seem at first glance. It can be broken down into 3 essential steps: choosing the right historical data, executing the backtest, and analyzing the results. Let's dive in, shall we? First things first, you need to choose the right historical data. Now you might be thinking, but why historical data? Well, to put it simply, historical data gives us a glimpse into the past performance of a currency pair. It allows us to simulate trades based on past market conditions to see how a particular strategy would have fared. It's a bit like having a crystal ball, except this one is powered by cold, hard data. But not all historical data is created equal. You'll want to pick data that is as accurate and as comprehensive as possible. It should cover a substantial period and include the highs, lows, opening, and closing prices for each period. Remember, the more detailed the data, the better your backtesting results will be. Once you've got your historical data in hand, it's time to move on to step 2, executing the backtest. This is where you'll be applying your trading strategy to the historical data to see how it performs. There are numerous software tools out there that can assist you with this. Some are free, while others are paid. Choose one that aligns best with your needs and budget. Executing the backtest involves setting the parameters of your trading strategy, such as the entry and exit points, stop loss, and take profit levels, among others. The software will then simulate trades based on these parameters and the historical data. It's like running a dress rehearsal for your trading strategy, except the audience is made up of past market conditions. Finally, we arrive at the third stage, analyzing the results. This is arguably the most crucial part of the process. The data generated from the backtest will give you insights into the performance of your trading strategy under different market conditions. It will show you the number of winning trades, the number of losing trades, the average profit or loss per trade, and the maximum drawdown, among other important metrics. Analyzing these results will help you understand the strengths and weaknesses of your strategy. It allows you to make necessary adjustments and improvements, ensuring that your strategy is as effective and efficient as possible. That's the basic process of backtesting, but it's not just about going through the motions. There are some key points you need to keep in mind, and we'll delve into these in the next segment. Stay tuned. When backtesting your Forex trading strategy, it's important to remember a few key points. Firstly, always ensure you are using quality data. Without accurate and reliable data, your backtesting results will be flawed and your strategy may not perform as expected. So, always source your data from reputable providers and double-check it for consistency and accuracy. Secondly, consider the market conditions. Different strategies perform better under different market conditions. For instance, a strategy that thrives in a trending market may struggle in a range-bound market, and vice versa. Therefore, when backtesting, ensure you test your strategy under various market conditions to gauge its versatility and adaptability. Thirdly, while backtesting is a powerful tool, it's essential to understand that past performance does not guarantee future results. Just because a strategy performed well in the past does not mean it will do so in the future. Market conditions are ever-changing, influenced by a myriad of factors, including geopolitical events, economic news, and investor sentiment, to name a few. Moreover, it's crucial to remember that backtesting is only a part of the entire process. It should be accompanied by other forms of analysis and risk management techniques. For instance, use forward testing to validate your backtesting results. Forward testing, also known as paper trading, involves testing your strategy in real time on a demo account, which can provide further insights into its effectiveness. Lastly, don't forget to factor in transaction costs. These costs, such as spreads and commissions, can significantly impact your trading results. So, ensure you include them in your backtesting to get a more accurate picture of your strategy's profitability. Remember, the ultimate goal of backtesting is not to find a holy grail strategy that never loses, but to identify a strategy that suits your trading style and risk tolerance, and that consistently generates profits over time. Keeping these points in mind will help you conduct more effective and reliable backtests. So there you have it, a step-by-step guide to backtesting your Forex trading strategy. We've journeyed together through the intriguing landscape of backtesting, a tool that can make a world of difference in your Forex trading journey. We started by understanding what backtesting is, then moved on to the process of backtesting, and finally, we delved into some key points to remember about backtesting. Let's take a moment to recap. Backtesting is a method of validating your trading strategy by applying it to historical data. It's like a time machine that allows you to test your strategy against past market conditions to see how it would have performed. It's a crucial step in developing a successful Forex trading strategy, as it allows you to understand the potential strengths and weaknesses of your approach before you risk actual money. We also discussed the process of backtesting, which involves defining your strategy, collecting and preparing data, backtesting your strategy against this data, and then analyzing the results. Each step is crucial, and skipping one could lead to inaccurate results. Finally, we touched on some key points about backtesting. Remember, backtesting isn't a guarantee of future success, but rather a tool to help you refine your strategy. It's also important to use high-quality data for backtesting to ensure accurate results. And don't forget, it's crucial to backtest your strategy over different market conditions to get a comprehensive understanding of its effectiveness. So, what's next? It's time to put what you've learned into action. Take the time to backtest your strategies. It may seem like a lot of work, but the knowledge and confidence you'll gain are priceless. Keep exploring, keep learning, and keep refining your strategies. Forex trading is a journey, not a destination. Remember, A well-tested strategy is a key step towards successful Forex trading. Happy trading, and until next time.